Sure. So that's actually a very good question, right? We don't want to be brave for the sake of being brave. For us, the number one rule is capital preservation. We do not like asymmetric outcomes. So if you tell me there is a stock that can go up 100% or 200%, but you can also lose 100% of the capital or 50% of the capital, I'm not interested. We don't have any stocks in our portfolio. We hope we don't have any stocks in our portfolio like that. We constantly screen to make sure that we don't have those asymmetric outcomes. Now, something can completely come out of the blue to change the entire thesis. But outside of that, if knowingly we do not make those kind of bets. Now, what is contrarian is there are a lot of times when sectors fall out of favor or companies fall out of favor. It could be because people in general are concerned, or markets in general are concerned about a particular sector, the earnings power of a sector, or it takes too much time and effort to really dig in and understand to come up with enough conviction to back your investments. So for us, it's all about, it's not being contrarian for the sake of being a contrarian. We always would like to have a big margin of safety. We're also looking at, it's a probabilistic thing for us as well. So if we're completely wrong on our thesis, what is the risk to our capital? So for our portfolio, I think we have very little to no exposure to commodities in general. And the reason for that is in commodity markets, it's very important to call the cycles, at least from our perspective. We might have an occasional service provider that dabbles directly in commodities, but the way we get our exposure to commodities is through industrials. So if you have a large, well-managed industrial company, then roughly about a third of their revenue should come from oil and gas industry, and maybe another 10 to 15% should come from other commodity industries, metals and materials industries. So we have industrials within our portfolio that have exposure to commodity space, and so they do get hurt when the commodity market weakens materially. Clearly their capex gets impacted and their earnings power is impacted, but we don't have a direct exposure to commodity market because through the cycle we feel that the returns on capital that the commodity businesses usually generate are not adequate for us.